Welcome to The Deep Dive, the show that takes your sources and extracts the sharpest, most surprising insights, giving you the definitive shortcut to being well-informed. Today, we are plunging right into the guts of the global economy. Freight logistics. We're talking about this nearly $1 trillion infrastructure that gets, all your goods moved across the continent. But this isn't a story about massive stability. It's about a high-stakes, highly fragmented industry.
It really is.
And it's one that's undergoing a massive digital transformation while at the same time fighting this sophisticated, escalating war against fraud.
It's such a study in contrast. I mean, this is an industry that transports over, 73% of U.S. freight by weight?
Wow.
And it's defined by this tension. You have these complex, labor-intensive human interactions for brokering.
Right.
Existing right alongside this incredibly rapid digital evolution. The fundamental challenge is just matching millions of shipper loads with a supply chain that's dominated by really small players.
Yeah, the sources mentioned that 95.5% of modal carriers operate 10 or fewer trucks.
Exactly.
Yeah.
And that fragmentation, that's what creates the perfect storm.
Yeah.
You have immense profit potential, but also these massive windows for catastrophic risk.
So our mission today is to give you a clear map of this volatile landscape built entirely from the research you sent us. We're going to tackle 3 core areas. First, we need to clearly define the 2 critical players. The freight broker versus the freight broker agent. They sound similar, but they're very different.
Very different.
Second, we're going to confront this escalating, multi-layered threat of freight fraud. We'll look at the tactics criminals are using and the, frankly, staggering financial losses involved.
It's a huge problem.
And finally, we'll analyze the mechanisms that these digital platforms are deploying to maximize their profit in this complex environment. Specifically, we're looking at the surprising success of hybrid pricing models. Okay, let's unpack this. Let's start by setting the stage. Who exactly is moving all this freight? Because if you don't understand the roles, you can't possibly understand the liability.
Exactly. So when you hear the term freight broker, that refers to a licensed, regulated entity.
Okay.
It could be a small operation, just one person, or it could be a massive multinational firm. The core thing is that they hold a license from the Federal Motor Carrier Safety Administration, the FMCSA.
They're the middleman.
They're the essential middleman, matching shippers who need freight moved with the carriers who have the truck space.
And it's more important than just matching, right? It's the risk they take on. The broker is the entity that's legally and financially accountable.
Oh, absolutely. Their primary responsibility is compliance with all those FMCSA guidelines.
So making sure carriers have the right authority, the necessary insurance, a clean safety history, all of that.
All of it. But the operational burden is huge, too. The broker is the central financial hub. They have to assess the shipper's credit, handle all the invoicing, chase down payments.
Deal with bad debt.
Exactly. And then make sure the motor carriers get paid on time. They manage the entire business, including any independent agents they bring on.
Which brings us to that second key player, the freight broker agent. This role is pure sales.
Pure sales, the relationship builder. They are all about customer service and volume.
And they work under the license of a licensed broker, right? Almost always as a 1099 independent contractor.
That's right. So the agent's work is really focused. Finding loads, quoting rates, sourcing the right carriers, and then managing dispatch and scheduling.
And their huge advantage, and the reason this model is so popular, is the trade-off.
It's all about liability. The agent isn't required to be licensed or bonded themselves, and they carry very little direct liability for any of the compliance or financial fallout.
So if an agent makes a mistake or a load goes bad, the broker is the one who bears the legal and financial brunt of that.
Precisely. The agent is shielded. It lets them focus, really intensely on building customer relationships and moving volume.
And their compensation reflects that.
It does. It's straight commission, typically between 50 and 70% of the gross profit margin on the load.
We had a great example in the sources that really clarifies the math for you. Say a broker bills a shipper $1,500 for a load.
Okay.
And the carrier gets paid $1,300. That leaves $200 in gross profit. If the agent has a 60% commission, they walk away with $120.
Right. They've successfully moved the freight, built the relationship, and gotten paid, while the broker keeps the remaining $80 to cover their substantial overhead, their compliance risk, and crucially, all the liability for that load.
That structural separation is why the system works. It allows agents to specialize in sales.
But it also means the broker, the responsible party, is disproportionately exposed when that fragmentation opens the door to criminal elements.
Which leads us right into the problem that is just plaguing this industry right now. With the broker carrying all that liability, what happens when things inevitably go wrong in this highly fragmented system?
Well, the sources make it clear. Things are going dramatically wrong. And the financial exposure is, it's terrifying.
How bad is it?
Cargo theft incidents are forecast to rise by 22% by the end of 2025. And the financial hit for every single incident is astronomical.
I saw that number. The estimated average value of an individual theft is now over $202,000.
$202,000. That's a massive life-altering hit for a small brokerage.
And the vulnerability isn't just about security, gates, and locks. It's baked into the regulatory system itself. Your sources point out that the FMCSA has actually acknowledged that its own registration system is outdated.
Yeah, they know it needs an overhaul to control fraud.
So brokers can't even rely solely on the federal stamp of approval when they're vetting a new carrier.
You're exactly right. The very system that's supposed to protect them is lagging way behind. Criminals are incredibly sophisticated now, and they're targeting those weak links in the digital and vetting processes.
And the sources identified 3 major threats that are hitting brokers the hardest.
That's right.
First up, you have the classic, but increasingly advanced, cargo theft.
Yes. This is where thieves use identity theft to basically circumvent the whole vetting process.
So they pretend to be a legitimate trucker.
They'll either take on the credentials of a legitimate trucker, that's often called strategic theft, or they'll contact brokers directly using stolen US DOT numbers. And it's often underreported, so the true scale of the problem is probably even bigger.
Okay. Second, we have double brokering.
Right, and this is deeply unethical and often illegal. It happens when a legitimate carrier accepts a load from the broker and then illegally transfers it to a third unauthorized carrier without telling the original broker or the shipper.
So they're just secretly subcontracting it out.
And that creates catastrophic risk. It can void the entire agreement. It exposes the broker to huge financial loss, and it could even strip the original carrier of their FMCSA authority.
You're introducing a totally unvetted, maybe uninsured party into a high-value chain.
All to arbitrage a slightly higher rate, usually.
Yeah.
It's incredibly dangerous.
And the third major threat is just pure identity theft, which has become terrifyingly high-tech.
It really has. Unauthorized load brokering using stolen US DOT numbers is rampant. Criminals intercept sensitive data, often through phishing scams, to impersonate carriers. But here's where it gets really scary.
The deepfake technology.
That's the chilling part. Deep fakes make voice impersonation easy, so a criminal can get contact info, call the broker, and simulate the voice of a trusted carrier rep.
So that adds a critical risk layer to just a standard voice over internet protocol or VoIP call.
A simple phone verification is no longer safe.
Wait, so if I'm a small broker, you're telling me I'm now potentially fighting against state-of-the-art AI on a routine phone call?
That's the new reality.
That fundamentally changes the level of due diligence required. I mean, moving beyond basic paperwork seems like an immediate necessity.
It is. Due diligence has to be multi-layered and rigorous every single time. It starts with the basics, sure. Conduct background checks, confirm phone numbers.
But not just by using the number on the paper.
Correct. No, you have to call the carrier's publicly listed main line directly. Verify their authority and DOT number. Cross-check their email against the one on their registered authority. Look for consistency.
But the sources also stress looking for those behavioral or logistical red flags, things that just don't quite make sense.
Exactly. We had that great example of the day cab red flag. You should be questioning a driver who tries to haul a 3-day long-distance load using a day cab.
Because that's a truck built for short, local routes.
Right. It immediately suggests they might not be the legitimate long-haul operation they claim to be, or maybe that they're being used by a double broker. Those are the human instincts that save a broker $200,000.
And beyond the human element, technology has to step up.
Of course. For basic security, implementing multi-factor authentication and strong passwords, that's non-negotiable.
But specialized tools are now critical.
Especially those that can alert the platform when a call is coming in via VIP. That flags the conversation as potentially requiring extreme caution because of that deepfake risk we just discussed.
And then we get to the final crucial barrier, process controls.
These are the internal safeguards that protect the cash flow. Brokers absolutely must use payment holds, especially for any new or unvetted carriers.
And only release the funds once the delivery documentation is fully verified.
Fully verified. And when you say verified, the sources are very specific. They mean you need to require original, unaltered documents, like the bills of lading.
Isn't requiring original documents in a digital world kind of unrealistic? Doesn't that slow everything down?
It absolutely creates friction. But that friction is the necessary cost of security in a high-risk environment. The trade-off is simple. A minor delay is far cheaper than eating a $200,000 loss.
It's the last firewall.
It is. It's the last firewall against the identity thieves and double brokers who rely on falsified papers and rapid, unverified transactions. But ultimately, the easiest protection is still building strong relationships with known, trusted carriers.
And if the worst happens and fraud is confirmed, the response has to be fast and standardized.
The immediate reaction has to be financial. Stop all payments. Immediately.
Right.
Then secure all the documentation, notify your internal compliance teams, alerts the affected parties.
Shipper, the legitimate carrier.
Right. And crucially, report any cyber-related fraud, which often involves wire fraud, to federal authorities like the FBI's Internet Crime Complaint Center, the IC3.
So we have this vast, fragmented, high-risk world, and now we need to look at the digital platforms trying to tame this chaos. These threats really underscore the complexity of matching supply and demand. Let's shift our focus to how these platforms are optimizing the way they price and sell loads digitally.
If we connect this to the bigger picture, the entire operation of these digital marketplaces, it really boils down to a fundamental concept called mechanism design.
Mechanism design.
Yeah, they need to create rules, pricing, and payment rules that maximize their long-run average profit while efficiently matching all those millions of loads to thousands of small carriers.
And the sources outline two main mechanisms they use to do this. The first is the simplest one, the posted price mechanism.
That's the static model. The platform calculates and sets a fixed price for a load. A carrier sees it, and if they like it, they can instantly book it at that price. It prioritizes speed and simplicity.
The second, and increasingly profitable approach, is the hybrid or dual channel mechanism.
Right. This gives the carrier a choice. They can either instantly book the load at the platform's posted price, just like the static model, or they can choose to submit a bid in an auction for a potentially higher payment.
So there's a key trade-off here.
There is. Choosing the instant posted price means immediate confirmation, guaranteed work. Choosing the auction means you might earn more money, but you have to wait. You risk the load being given to someone else while you're waiting.
This dynamic introduces a genuinely fascinating area of research. And when platforms compared these two mechanisms, the findings were, well, they're overwhelmingly clear.
The hybrid model yields measurably higher profits for the platform.
Not just a little bit, right?
No. The numerical studies using actual U.S. freight data confirmed it. Hybrid models achieved anywhere from 7 to 17% lower overall carrier costs for the platform.
Wow.
And that resulted in higher market efficiency. So, fewer loads just sitting there unmatched. Financially, combining the fixed price with an auction channel is just the superior choice if you're a platform seeking maximum profit.
This sounds like a complete no-brainer for the platforms then. But here is the aha moment, the major insight for the entire industry. Despite the option to bid for potentially more money through that auction, over 87% of carriers choose the instant posted price.
They willingly leave money on the table for the sake of speed.
Why? Why would they do that?
It comes right back to the deep fragmentation of the market, that 95.5% of small operators. These small carriers, they prioritize minimizing dead runs, driving empty, and maximizing utilization.
Time is money.
Time is literally money. Guaranteed work right now is often worth much more than the chance of a marginally better rate later. The anxiety of waiting for an auction decision and maybe losing the load is higher than the benefit of that small potential profit increase.
That's amazing. That preference for speed is so dominant that the percentage of carriers choosing the instant price actually increases as the platform's overall load volume grows.
It does. It shows the hybrid model works not just because it has an option, but because it perfectly caters to the carrier's dominant preference for transaction speed through that fixed posted price channel.
It's a mechanism that maximizes platform profit by respecting the carrier's need for speed and certainty.
Exactly.
What a profound synthesis of digital innovation battling physical complexity. We started this deep dive by defining those high-stakes roles, the freight broker, the licensed entity taking all the financial heat,
And taking on the compliance.
versus the agent, the 1099 contractor focused purely on sales volume.
We then confronted the staggering financial risks now facing that broker, noting cargo theft incidents are rising sharply, with the average loss soaring above $202,000 per incident.
Which has forced brokers into adopting these multi-layered due diligence protocols, advanced tech checks against deepfake voice impersonation and rigorous process controls like mandatory payment holds.
And finally, we saw how this fragmented market, where certainty is king for the carrier, is being expertly optimized by digital platforms.
The evidence shows that while the hybrid dual-channel approach is financially superior for the platform,
Lowering carrier costs, increasing efficiency.
the vast majority, that 87% of carriers, still opt for the simplicity and speed of the instant posted price.
This raises an important question. While digital marketplaces have clearly demonstrated the financial superiority of the hybrid model, combining a fixed price and an auction channel, the underlying research reveals a deeper truth.
Oh.
We found that even the simple static posted price mechanism can be what's called asymptotically optimal, meaning equally efficient, but only when both shipper demand and carrier supply become very, very large. Therefore, the core challenge for these platforms isn't just which mechanism to use.
It's something else.
It's understanding the precise scale and density of the market at which simplicity becomes competitive with, and maybe even superior to, complexity. It makes you wonder how long the complex hybrid models will truly dominate if platforms continue to grow exponentially.